Manish Gangwal, CFO at Gulf Oil Lubricants, joins in on the show right now to talk about how their next 5 years are going to pan out for the business. Manish, hi, morning. Over the last 5 years, you've comfortably outgrown the industry. Can similar trends be seen even for the next 5 years, you think? And if yes, what kind of growth is it that you're projecting, and by how much will you outperform the industry?
Yeah, first of all, good morning and thank you for having me. Yeah, of course, I think we have been outgrowing the industry 2 to 3x over the last decade, not only 5 years. So that has been our sort of internal mantra. And obviously, with the kind of product launches and with the kind of initiatives and segment-wise focus which we carry, we believe that we can continue to outperform the industry and keep growing 2 to 3x the industry in terms of volume, which translates to nearly double-digit revenue growth on a CAGR basis. So overall, yes, we continue to aim gaining market share across B2B, B2C, both segments, and also looking at sort of minimizing our portfolio while continuing to look at the value-driven segment. So overall, yes, the trajectory what we look at is to continue to grow 2 to 3x the industry.
Absolutely, Mr. Gangwal. But while you're going to be focusing on a lot more in terms of premiumizing as well, but given that there's a rise in the number of EVs, what kind of demand impact are you expecting? Are you envisaging any sort of an impact in terms of will be compensated? How will you compensate the higher demand of EVs that you're seeing?
So we have been always telling the larger community and all stakeholders that the lubricant demand will continue to be 2 to 3% over the next decade and more, because India is a low vehicle penetrated country. Overall, the GDP growth continues. The infra impetus is there from the government, and there is a manufacturing in India concept, or make in India is now becoming very prominent. So industrial segment also is there. So all these lead to a conclusion, and recently, in mid of 23, we published a sort of report from Klein, which is a global agency looking at lubricants. And that also confirmed that the India market, which is the third largest market in the world, will continue to grow 2 to 3% in terms of volume. And that has been the trend for the last 10 years, and that will continue for at least a decade and more, if not beyond. So we believe that in spite of decarbonization, the total lubricant demand will continue to be growing 2 to 3%, and we have been growing 2 to 3x of that. So overall, we do not see, there will be some sectors which will be impacted by EVs in medium to long term, like some of the two-wheeler segment and buses and three-wheelers. But overall, the demand of lubricant will continue to be growing at least for a decade and beyond. That is what we envisage, and for the industry and for us as well.
So in terms of overall, you're expecting this EV fuel demand in India to grow around 12 to 14 million liters in 2028. What is Gulf Oil's market share that you're seeing? You're highlighting that, but what is the market share that you're expecting here then?
So overall, we have roughly 6 to 7% market share today. And with the outgrowing of industry by 2 to 3x, we have gained nearly doubled our market share over the last 10 years. And we believe that there is a lot of headroom for us to continue to gain momentum and get market share in terms of our lubricant. And we are very strong in terms of not only the Bazaar market, which is B2C. We are, because our brand has become clearly in top 3 brand in the lubricant space in India, as well as our distribution. There is a lot of headroom to keep growing our distribution both in urban and rural, which will help us to continue to gain market share. While we do not chase a particular market share number, but overall we believe that if we keep growing 2 to 3x the industry, our market share will continue to grow up in the lubricant space across both B2C and B2B.
Then, Mr. Gangwal, what is the outlook when it comes to your margins? Do you stick to 14%, or will that number change largely also on the back of the fluctuations in oil prices?
So as far as crude is concerned, as we all know, it's a fluctuating commodity. But in the lubricant space, there is an ability to pass it on when there is an increase in the input cost. And there are, in the OEM segment, there are price variation clauses which protect the margins. But our we have been striving internally, and one of the key theme which we have taken on is also to premiumize in certain categories of our portfolio. And we have launched new products in the premium segment while continuing to, again, I mentioned that some value segment products are also launched. But premiumization efforts will definitely help us keep moving the margin band to the next trajectory. Also, our focus on top line growth continues, which will help us to bring in more operating leverage, which will show and improve performance at the EBITDA level. So obviously our current band is 12 to 14% EBITDA, and we not only want to maintain that, but over a period of time we want to move to the next trajectory of 14 to 16% over a period of time.
Gangwal, just going back to the point in terms of market share. So what is the market share right now in terms of the EV fluid segment for you?
EV fluid segment is a very, very small segment, very, very small segment today of the total market demand. And we are already working with at least 7, 8 OEMs in the EV space in terms of EV fluid, but the demand is very, very negligible, I would say. So it's very difficult to anticipate market share at this stage because the volume itself is less than 1% of the total industry volume.
What about the stake that you've acquired in the 3 EV-related businesses? Are you planning to increase stake? How are they shaping up?
So right now we are nurturing these EV investments. We have recently acquired a company called Tyrex. They are into DC fast charger manufacturing for EV vehicles. Earlier we had acquired a company in SaaS related software as a service for EV vehicles. And before that we had also acquired some stake in the AC small home charger company. So all those investments we are currently nurturing, and of course we look at increasing the stake at an appropriate time. But as of now, we want to just help them grow their businesses to a meaningful level. We believe that the EV charger industry is poised for a significant growth over the next 5, 7 years, given the government also is pushing for electrification, at least in oil companies, fuel stations. Across buses specifically, EVs are going to come in terms of conversion of normal buses to EV buses. So all these areas augment well for fast charger business. And we believe that this market can be $1 billion to $1.4 billion by 2030. And we can play a meaningful role in that segment as well. And that's why we are helping them grow their businesses to a significant level.
Mr. Gangwal, right now you mentioned that EV fluid, obviously the segment over there, your market share is very negligible right now. It's a small part of the business. 2 years, 3 years down the line, where do we see that market share headed? And also for the fast charging market for the company, how is that also moving? And what are you looking at in terms of opportunities in both the places in terms of market share?
So EV fluid, as I mentioned, we are working with already 8 OEMs plus. So we have a meaningful presence in that segment, but market share calculation is not possible because the size is very small. On the EV charger side, the fast charger segment, as I mentioned, can be $1 billion to $1.4 billion. And our acquisition company, Tyrex, they already have nearly 8 to 10% market share. We want to obviously increase that market share with the help of strength from Gulf Oil. But even if we maintain that 8 to 10% market share over the next 5, 7 years, you can imagine, it can be a $100 million plus opportunity in terms of top line.
Okay, great to have you on the show. Thanks so much for speaking with us today.
If you like this video, then like, share and subscribe to ET Now.